Another $33 billion in shareholder wealth up in smoke. Fragile investors were expecting a rough ride today on the Australian and Asian markets, and that's exactly what they got. The ASX 200, which comprises the top 200 companies, fell to its lowest level in more than 2 years. The turbulence is due to America's credit rating downgrade and the debt crisis in Europe. Here's finance correspondent Philip Lasker.
Many Australians spent yet another day watching their wealth evaporate, and they're scared.
We think we're going to change our strategy and our superannuation and get out of shares and go to cash.
I think it's a bit scary at the moment. The whole world's got too much debt.
Those fears played out again today as widespread selling sent the ASX 200 down nearly 120 points, dropping below 4,000 for the first time in more than 2 years. So today's near 3% dive means the market's off more than 11% this month, and almost 20% since the April peak. That's surprised even the experts.
We have sold off quite hard. Probably slightly harder than we expected over the weekend.
Likewise for the rest of the region, where the major markets dived more than 2%. With much of Asia's savings invested in the giant US bond market, Japan's finance minister was forced to come out in support of the world's biggest debtor nation.
The pathway has opened up after the United States decided to substantially cut its deficit. With full implementations of what has been agreed, I believe that US government bonds remain an attractive financial product.
Credit ratings agency Standard & Poor's, which is under attack for downgrading the US amid the turmoil, said its actions would not have any immediate consequences for the Asia-Pacific region. But longer term, there'll be less business from Asia's debt-riddled customers in Europe and the US.
That has the potential to either delay Australia's recovery or weaken the current downturn at the moment. That said, we believe that the Australian outlook is still relatively sound.
Interest rate markets are in global financial crisis mode. They're pricing in the chances of a 0.5% rate cut at next month's Reserve Bank board meeting.
The market is pricing in a risk of a very significantly bad outcome.
And that's a risk that becomes more likely if the markets in Europe and the US sell off heavily yet again. Philip Lasker, ABC News.